The government has moved on easing the commercial coal mining by private players, a move that is bound to disrupt Coal India's monopoly in the country. Now, one may well ask why the move at a time when the world, including India, is moving towards renewable energy sources. The fact remains that India will continue to depend on this fossil fuel for some time to come. Chetan, Phalke, the CEO of Invesco Research, has put out a detailed blog which lists out the reasons why the government move could aid not only the mining sector but have larger ramifications for banks as well. He joins us now for a chat on that and more. Chetan, good having you. Thanks so much for joining in. And when we looked at or when we read your blog, it seemed that there are multiple layers of impact that come in as a result of these. Would you, in a nutshell, elaborate why do you think this has multiple benefits?
Yeah. So I think, Neeraj, it's a very large reform, and I think it has pretty huge implications both at the macro level and from stock market perspective as well. But somehow there's a muted response, and we are very surprised to it because it is as big as, let's say, a discovery of a large oil and gas block, or let's say you're opening up your aviation sector for the very first time, because it will throw up a lot of private players in this space. Because, see, in oil and gas, we are not even 1% of global production or reserves. But in coal, we are 9.5% of global production and reserves both, yet it doesn't get that attention which it deserves. So what has really happened? First, the FSA, the fuel supply agreement issue, is likely to get resolved because the availability of domestic coal is going up. So it's a seamless transfer of mines. Under these new auctions, if you win a mine, you don't need a fresh environment clearance or forest clearance. So your production starts pretty quickly. Second, now the end use clause has been removed. So that means the merchant mining can start in a big way for the very first time. So global private players can come in, which means a lot of FDI can come into this space. So India is the only country wherein our coal production is likely to double over the next 10 years from 700 million tons to something like 1400 million tons. And we are the second largest coal importer globally. So when the second largest importer is withdrawing from global markets and substituting with domestic coal, it will have impact on international coal prices as well. So it is in the interest of global coal miners to come to India and have some kind of a strategic presence over here.
Which is actually going to be my question to you. What do you think is going to drive the interest of global players to come and apply for these mines or try and get a hold of these mines? Because currently also our own prices that Coal India has is far lower than global prices. So is it from the aspect of having a presence here where you acquire coal at a lower price and then you look at getting it back out because prices are anyways higher outside, you're getting a better rate outside?
No, but the cost of production is also lower if you come here. So Coal India, if you see, their cost of production is somewhere around 1,300 rupees a ton, out of which 700 rupees goes to employee cost or the employee cost per ton. So when private players comes in, their efficiency will be far higher or far better.
So it will go down further.
Yeah. So they will be able to produce coal at a far lower rate. So despite having to compete with Coal India, and as I said, there is no demand issue over here. So even Coal India can continue to grow their production at 5-6%, and the other players, the private players, they can continue to supplement the import substitution. So because, see, we are importing around 230 to 40 million tons of coal today, out of which some 100 million tons is consumed by coastal power plants. So it cannot be substituted. These power plants are designed for imported coal. But the 120, 130 million tons, that is definitely substitutable. So on one hand, your coal demand is going at 5-6%, and you are going to substitute the import with domestic demand. So on the demand side, there is no issue.
Okay, and therefore, the global player might not want to miss out on supplying to the Indian demand and might want to set up operations here. So let's say that we establish that there will be foreign interests coming in out here. So that is one, that there will be an opening up, there will be interest. Now, how does this impact what happens? I mean, let's say production moves up over the course of the next few years. What implications does all of this have to the various related parties involved in this whole coal mining to coal usage space?
Okay. So at a macro level, there are two large first order effects. First is, I think, of course, your imports will come down, and which amounts to almost 1 lakh crores over the next 4 or 5 years. That's why I said it's as large as discovery of an oil block. So just you're reducing your imports and adding it to the local economy. So just imagine the kind of multiplier effect it will have, especially in the states like Jharkhand and Chhattisgarh, wherein almost 10% of the state revenue comes from the coal or coal-related taxes. And plus you have FDI come in. So that is the first effect. The second large order effect, I think, will be on the distribution companies, because as we speak, they are in a miserable state.
The discoms.
The discoms. So they owe almost 80,000 crores to all the power generation companies. And out of these 80,000 crores, 55,000 crores is due for more than 6 months. Now, considering that we produce almost 1,000 billion units of power every year, so as the availability of domestic coal goes up, the mix of cheaper power will go up. Now, why I say that? Because when you use imported coal, the cost per unit or variable cost of coal per unit is around 2.5-3 rupees. When you replace it with domestic coal, it will be around 1.5 rupees per unit. And if you have captive power, captive coal mine, then it is even lower. So on 1,000 billion units, if you are saving, let's say 30 paisa over the next 2-3 years, I'm not saying it's going to happen overnight, but structurally we are going in that direction. So even if there is an improvement of 30 paisa, last year FY19, discoms did a loss of 27,000 crores. So they can effectively wipe out their losses, and they're not going to pass on this benefit to the consumers.
So it stays with them.
They're going to save it. They're going to keep it. And on top of it, you have transmission and distribution efficiencies which are coming in. So 3 years back, our transmission and distribution loss was, let's say, 21%. Now it is around 17.5, 18%. So structurally, the distribution companies, their health is improving. So once distribution companies are in a better place, then their ability to sign up PPAs, their ability to pay power companies on time goes up. And then that has large implications on a lot of power companies and the related value chain.
And coal mining equipment companies, and this also, what you just said, works well for all those banks that have almost written off getting paid back.
So if you're talking about how it will impact the listed space, then I think the biggest beneficiary immediately could be the PSU banks. Because
why so?
Because almost 25 gigawatts of power capacity is under stress. And banks have, by and large, they are provided for these assets. And these assets were stranded, or there were no takers for these assets because there were no FSAs and there were no PPAs. Now, fuel supply agreement FSA issue has been resolved, or will get resolved over the next 12 months pretty fast. On the PPA side, now the visibility has gone up. So suddenly the value of these assets has notched up a few points higher. So if the deals are happening at, let's say, 3 crore per megawatt, they may start happening at a substantially higher price. And mind you, these assets take a lot of time to come up. Like if you want to set up a power plant, it will take 5 years. So they have very high terminal values. So if you see PPA visibility over the next 3-4 years, their plant load factors will also go up because there is no demand issue per se. No, now when PLFs go up, their ROEs will also go up. So you have a combination of high ROE, no new supply coming up, and high terminal value. So the re-rating in the valuation of these stocks can be substantially higher.
How much? Like global power stocks compared to what they trade at versus India?
So on a normalized earnings, if your ROE is more than cost of capital, usually these stocks will trade at a PE of 12 to 15. So now you don't have normalized earnings because PLFs are lower. So as PLFs go up, your earnings will also catch up, and perhaps the valuations can also go up. So right now they are in single-digit PEs.
But is this a hope trade? I can understand banks because there could be some write-backs which were written off, and therefore it adds the recovery. Though I must say, I mean, everybody priced in recoveries from Bhushan Steel, etc., and the recoveries have happened. The market is not giving the due valuation because of other issues coming in for the PSU banks. But my question is, how much and how soon can these recoveries happen for banks from this power sector?
See now, so there are few power companies or private equity guys which are very interested in this space to acquire the assets and consolidate the space. Now, since the visibility has gone up, now you have a precedence of sorting out large assets due to SRC.
SR.
Right. So now these assets will get sorted up pretty fast. So someone like, let's say, JSW Energy, they have a pretty good balance sheet. They can re-leverage their balance sheet and acquire a few assets. So that's how we think these assets will be lapped up pretty fast. Because on demand side, again, I'll come back to that issue. On demand side, there is no issue and no new supply is coming up.
There has been a dip in the power demand as well, right, of late. The last 6 months, I've seen multiple articles, some stories on our website as well, which speak about how electricity demand, despite all this talk of there being a dearth, has actually dipped.
Yeah, so in last 3-4 months, yes, there is a bit of softness in the overall power demand. See, almost 50 to 52% of our power demand, both commercial and residential, it comes from top 15, 16 cities. 16, 17% of our power demand comes from agriculture. So a dip in a power demand cannot be attributed to manufacturing alone. Yes, manufacturing is a part of the slowdown can be attributed to manufacturing, but we should keep in mind the prolonged monsoon and the inability of DISCOMs to buy the power. So it's a combination of these 2-3 things which has driven the power demand lower. So we think it's more of a cyclical slowdown or a temporary slowdown and not a structural. Because in last 8 years, our power demand has moved from 115, 120 gigawatts to 175. And every year we are going up by 5-6%, adjusted for those 1 or 2% efficiencies in transmission and distribution. And mind you, just 2 years back, we had a very large EESL LED bulb implementation. So that one scheme alone has reduced our power consumption by 7 to 8 gigawatts. Now that is one full year's power production growth. So despite all these efficiencies coming into play, the power demand is going up at 5-6%, and now you have connectivity is going up under the Saubhagya scheme and all. So we think structurally the power demand is placed to go up. Now you just extend this 5-6% demand growth trend over the next 4 years. We are at 175 gigawatts today. So in 4-5 years, we'll be at 225, 230. So effectively, we are going to utilize our entire power capacity. So that's when, if you connect the dots, then to answer your question, I don't think it's a hope trade. Rather, I'll say till now, till the Coal Mines Act was amended, this theme had a very big potential. Now that potential has been converted into a high probability event, and that's how I'd like to put it.
I would actually want to extend on that. So are we saying, while all of this sounds really nice, are we saying that foreign investors, there's a beeline to come and invest in the Indian coal mines, and this was the only restriction stopping them, and now that this act has been amended, that barrage of investment is going to come in, or the fact that more than foreign interests, there could be other players domestically who would be interested in owning mines as well.
Yeah,
and the difference between that.
Yeah, so of course the domestic coal miners, they would be interested. Let's say someone like Vedanta can get interested in this space, or even the power plants who do not have captive supply, they might get interested. And now since you have this tax cuts which have come into the place, the global players can also get interested. And as I said, so we are the second largest importer. So as we substitute imported coal with domestic coal, it is going to have impact on international prices as well. And so such a large market which is going to double on a higher base from 700 million tons of coal production, if you're moving towards 1400 million tons, I don't think any global players, large global players, would like to miss out on this. So they would try and participate in this. Now there is no evidence to it that there is a beeline and players are just waiting to come in and all these things.
That's something that we're noticing maybe probably across sectors where...
Yeah, we have, but let's wait and watch.
Investment has been invited.
Yeah, let's wait and watch if this one is slightly different than the others. But we could have gone on, but Chetan, out of time completely. Would have loved to talk about Coal India as well, but just in a nutshell, Chetan Phalke doesn't believe Coal India debts negatively impact the results of this as well. But more on this on our website a bit later on in the day, or you can log on to Alpha Invesco's blog and read more about these impacts. Chetan, take a moment to thank you for joining in today and giving us your perspective.
Thank you.
Thanks for having me.